if you're holding, treasuries or cash, you're getting, gradually devalued with the risk of, a more sudden devaluation event and very little upside. And so I think basically there has been a good case for the past couple of years at least to substitute part of a bond portion of a portfolio with gold.
Thanks for joining us for part 2 of our interview with economic analyst Lyn Alden. If you haven't yet watched part 1 of our discussion with Lyn, in which she gives her outlook on the US dollar specifically and fiat currencies in general, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Lyn and our partners at New Harbor Financial share in this video. Oh, and if you haven't done so yet, please don't forget to subscribe to this channel by clicking the red subscribe button below, as well as that little bell icon right next to it. And now, here is part 2 of our interview with Lyn Alden. Great, well, let's move on quickly to commodities here. Specifically, I actually want to talk about precious metals, but you mentioned commodities earlier. Anything you might want to say about them, because I suspect that some of these sectors you're talking about that are undervalued relative to the rest of the market may be a lot of the commodity producers. I think most people watching have seen that chart that we put up many times in the past that show the relative value of the commodity complex to the S&P. And it's beginning to start heading towards the mean, but it's got a long way to go still. So specifically, so say whatever you want to say about commodities in general, but specifically about precious metals, more conventional investors, guys that weren't gold bugs, didn't really invest in gold before, perhaps at all. Thinking of folks like billionaire Sam Zell, but there's been a parade of other billionaires that have followed him recently, are moving into the precious metals. And I guess the question is, do they see something coming that the rest of the world hasn't woken up to? I mean, a lot of folks watching here already kind of know the general case for precious metals, but I've been hearing a lot, both from today's conference speakers, but just a lot of the folks I've been interviewing on the program here over the past couple of months, that they see gold, and really silver even more so, better positioned both technically and fundamentally than they've seen it in years, if not decades. Do you see similarly?
I do. I think this is still a really good environment for gold and silver. I became bullish on them starting in late 2018, and we've had some corrections along the way, but I think that this overall bull market is still intact. And basically, if you look at back in 50 years of data, gold's strongest correlation inversely is with real interest rates. And so if you could hold a 10-year treasury and get paid 7% while inflation's 4%, that's not a bad deal for a relatively safe asset. But if inflation's 3% even, but the treasury yield is only paying you 1%, well, suddenly that's a really terrible asset to own, and suddenly a zero yielding scarce asset like gold is a lot more attractive. And so what I think a lot of these investors are seeing is that we've been in an environment for a long time of negative real rates on the front end of the curve, and that's still likely to persist for a long period of time. The Fed is specifically willing to let inflation overshoot their target while holding rates low. And so if you're holding treasuries or cash, you're getting gradually devalued with the risk of a more sudden devaluation event and very little upside. And so I think basically there has been a good case for the past couple of years at least to substitute part of a bond portion of a portfolio with gold, because you get similar defensive characteristics with an inflation hedge, and it basically diversifies that risk. So you don't have, say, a whole 40% of your portfolio sitting there in treasuries or something like that. And so I do think that gold has historically been a good diversifier, especially in this type of environment with negative real yields. The other big correlation that gold follows is broad money supply growth. And the year 2020 had the biggest percent increase in broad money supply since the 1940s. And so a lot of investors have watched that and are paying attention to that. And so I do think that going forward, gold and silver and other precious metals are well positioned. And then if you look at in the broader commodity space, I think that's one of those things where you can, because it's a very volatile sector, you can get ones that are temporarily overheated and things like that. So for example, copper and lumber have been really consensus trades for a while. That might be cooling off to some extent. But for example, energy is still a very, very hated sector for the most part. And there are other types of commodities out there that are just not very well loved. And so overall, I think that, the market might be excited about commodities in kind of the near term, but the market is still not, positioned for a multi-year commodity run. and I think that's actually pretty likely to happen. And so, for example, I'm pretty bullish on energy companies. I'm pretty bullish on some of the industrial metals companies, and I do think that they play a really valuable role in today's portfolio.
Yeah, I mean, I think that for some reason a lot of investors forget that there's the economy can't do anything without energy, right? So when energy is underpriced, it's usually a sign that you know, something important's on sale. Also, a lot of the more recent stimulus packages, you know, who knows it's going to pass, but you know, Biden just proposed a $6 trillion one. Those are all to build things, right? And we had Rick Rule in the program not that long ago talking about just sort of the structural supply shortages that are going to emerge. So even on those base metals, like you're talking about, you know, there's certainly a big tailwind against that sector. All right, God, there's so much I want to talk to you about this. We're just crunched for time, but I will squeeze in this one last question about precious metals, because you mentioned something really interesting, that you see gold as a good kind of bond substitute in a portfolio given current conditions. You know, when you think about the general sort of 60-40 positioning of most portfolios out there, you know, the average portfolio has almost no gold in it, right? And it wouldn't take many percentage points of what are currently allocated into the traditional portfolio in bonds into gold to just make gold explode. Is that correct?
Yeah, pretty much. And if you look at, the global market cap that's estimated to exist for gold is 10 to 12 trillion. But when you factor out central bank balance sheets and a couple other purposes, you really only have, a few or several trillion dollars in gold as an investment. And that's out of a sea of assets that are hundreds of trillions. And so it's a really small percentage of most investors' portfolio. And so, for example, if you were to see pensions all want to do a 5% weighting, that's a ton of capital floating into the space, let alone if every millionaire wanted to have a 5 or 10% allocation. And then retail investors, jump on when the price is in their favor. And basically, if most people want that non-zero position or more than a 1% position, basically that's a problem for price in a good way. And so overall, I do think that basically there's more upside for gold with say a 3 to 5 year view than the downside. And so that's why I'm willing to kind of hold through downside periods, because I still think structurally gold is really attractively priced here. And mostly what, in terms of timing, I basically, it follows the broad money supply generally over the long term, but those changes in real interest rates really set the tone for basically, whether or not gold is going up and down in any given quarter. And so really what gold likes to see is negative real interest rates that are also getting even more negative. That's kind of the best possible environment for gold. And so if people are ever confused about why gold might be correcting or might be popping, a lot of it is if you look at real interest rates, that can often tell you basically what's happening. And gold can either front run those a little bit by a couple of weeks or can lag those by a couple of weeks. But overall, there's a very, very strong correlation there.
All right. Well, I hate to do this, but I am going to ask you to sort of summarize your perspective on the cryptocurrency space in just a couple of minutes, which is very, very unfair. But a lot of the reasons we were just talking about gold, obviously people are attracted to the cryptocurrencies, sort of like your discussion of a lot of capital going into a small market. We've seen the prices of the crypto complex explode, since the beginning of the year. They've come down a bit, maybe even a little more than a bit, 50+% for a lot of them. But before I ask you about the price action, can you just sort of comment on your general outlook on cryptocurrency, both the technology and store value and all that stuff? Is it something that you see a bright future for, or what's your latest outlook?
So I view Bitcoin, for example, as an emergent store of value. So it's because of its volatility, it's kind of currently being in the process of finding its total addressable market. So it's a very volatile asset. So it's basically, technically, it is a store of value that can be self-custodied and basically held outside the system, similar to gold. But because it's so volatile, it's more like it's an investment in the idea that it's becoming a store of value rather than one already, except for people that are really hardcore with it and kind of just completely ignore that volatility. And so basically, when I first analyzed the crypto space in detail back in 2017, I passed on it. It was late in that cycle. We had that really euphoric price action. It basically made it so there's a big enough asset that someone like me that looks at multiple asset classes, it basically became on my radar. But the combination of euphoric price action and the big dilution among all these different altcoins and everything really kind of put me off the space, and I passed on it. But in early 2020, I became bullish on Bitcoin because the biggest downside of cryptocurrencies is, unlike say fiat currencies, that they're mandated to be used by a government, and then you have precious metals, where there's only a handful of precious metals, you can't make more of them. You can basically, they're each limited to how much we can extract from the earth. You can't just make a whole new precious metal to compete with the existing ones.
There's only so many elements on the periodic chart. Yeah.
Exactly. And so the downside of cryptocurrencies is that anyone can make a new one, and that threatens the value proposition, even if each individual currency has some degree of scarce monetary policy. And so really what it comes down to is whether or not one or two of them can develop a strong enough network effect where that long tail of thousands of other currencies don't matter. Kind of like how if a certain technical protocol takes over, like the whole internet runs on TCP/IP, it doesn't matter if there's like copycats out there, because it's the network effect is so strong that this 50-year-old technology has become the foundation of the internet and is really kind of still going. And so the question is basically whether Bitcoin's network effect is sufficient enough to allow it to kind of keep capturing the majority of the market share in that space, or if just the deluge of competitors will chip away at it. And so basically what I do is I look at all the kind of the major currencies. I figure out what made Bitcoin successful other than first mover advantage and basically the path dependence. And overall, I am pretty bullish on Bitcoin as a kind of a portion of portfolio that is adjusted for volatility and basically adjusted for someone's conviction in the asset class. And so there are people that go really hardcore and they put all their net worth in it or something like that. Whereas I take a step back and I say within the grand scheme of portfolio, along with my equities, along with precious metals, I do like having a Bitcoin slice in there, and I think that so far it's improved the risk-adjusted returns of the portfolio. And I am pretty optimistic on the technology, but basically my main risk analysis, or basically the thing I'm always critical on, is the network effect basically strong enough to kind of hold back all these competitors?
Yeah, and it sounds like your answer for the time being is yes, and that's why you're putting your money into Bitcoin. As an FYI, I just had a recent interview with Dan Larimer, who is a very early pioneer in the Bitcoin space. I asked him that same question, and he does believe that Bitcoin and Ethereum are basically too big to be displaced at this point in time, at least brand wise. They may swap out their technology stack over time for better technology, but those are going to be the winning brands in his mind. And again, nobody's got a crystal ball. Who knows what's going to happen, but he seems to agree with you. I'm just curious if you're comfortable sharing a ballpark. What sort of, you mentioned having a slice in a portfolio. What do you think is a prudent slice for Bitcoin in a well-diversified portfolio right now? Are we talking low single digits or something higher than that?
I think for most people, yes. I'm basically my case since early 2020 has been that probably non-zero is appropriate now, and that can mean different things for different people. Basically, I think that 1 or 2% at minimum makes sense for a lot of people once they understand it, and then of course some people are very high conviction on it, and so they can dial it up. And so I think 5% is reasonable for someone who's pretty solidly bullish on it. Going up to 10 or more% can make sense. But then once you get into really high levels, that's when you can have these big drawdowns that start affecting your overall portfolio. Another challenge that it's a really good problem to have, but another challenge that crypto investors have is that say they bought Bitcoin as a 5% position,
You got to
but then
rebalance.
but then it went up dramatically, and it's kind of like, well, do you trigger all these capital gains, or do you let that portion run, or do you kind of keep that separate? And so that basically your starting position is not necessarily something you have to maintain all the time, but basically taking into account tax efficiencies, taking into account your conviction level. I think there's a pretty broad range of what percentages are reasonable, and just overall my view is kind of basically have it as a slice.
Got it. Yeah. I mean, overall, it's a high quality problem to have if today's gains
Yeah.
keep continuing. All right. Sounds like you're saying don't put 100% of your portfolio in Dogecoin.
Yes.
All right. So last question about Bitcoin, cryptos in general. For those that are considering entering, I think a lot of their big question is just, hey, looking at the price action this year, these things have gone up so much. Do they need to correct further? The space has a long history of 80+% corrections. Do you have any concerns about excessive speculation in the prices of the cryptos at current levels?
So I did a couple months ago. I've been writing about that in my research service, where I was kind of separating the fact that I'm long-term still bullish on Bitcoin, but that it increasingly became a less asymmetric trade than when I started kind of pounding the table on that position in early 2020. And so basically, after you had that strong rise, I was kind of saying I still don't think this bull market's over. But when you start to get things like Dogecoin, basically, being mentioned on Saturday Night Live, or like, yeah, basically Uber drivers kind of trading cryptos while they're driving people around. that's when the whole space gets really frothy. And so overall, the big correction we had, if you look at, for example, Bitcoin's price history, this 50% correction, puts it in the top 6 of all time Bitcoin corrections. And so it's at the point where a lot of the froth has been removed. The consensus is pretty bearish on it now, especially for people that are outside of the crypto space that are looking in on it. They look at that chart and they say that's bearish. I think it's going lower. And so overall, I don't have a strong case about what it's going to do in a quarter or two. But overall, I do think that it's not a bad time to, if someone feel like they missed out on previous price action, to then look at the current weakness and say, maybe the top, Bitcoin, or maybe the top two, and say I want to have a small slice at that current time. And overall, one of my main kind of focuses on price, basically forecasting in the loose sense, is I look at some of the things that are happening on chain. So our long-term holders selling or buying, basically who's buying, who's selling. Basically, you can kind of analyze. That's kind of the interesting thing about the blockchain, is that you have these ways to look at it and analyze the data and see, what type of our exchanges is more coins coming to exchanges or leaving exchanges. Is basically short-term traders that sold, and we're basically there's kind of different groups you can monitor to see how they're behaving. Another thing you can do is look at demand, the big demand drivers. And so for a couple quarters, part of that big price increase was that you had a lot of grayscale buying. So the big grayscale Bitcoin trust, and part of that was natural buying, but another big chunk of that was arbitrage traders, where they would buy GBTC, but then they would short Bitcoin, and they basically would extract that premium that grayscale has over Bitcoin. But because that premium turned into a discount due to increased competition from other types of funds, that overall that neutral trade pretty much went away. And I think that had a lot to do with this big kind of price correction that we've had in the space. It basically set the stage for some of these other more temporary factors like Elon's comments and things like that to drive down the price. And so I think that the key to look out for next is to see what are the next sources of demand. And I think overall one of them might, for example, be Bitcoin rewards cards. You see, for example, companies like Fold or BlockFi are issuing these cards where you basically every purchase you get more Bitcoin, and then you have a company like NYDIG that's partnering with banks to have Bitcoin rewards cards. And so if you kind of see that starting to take off, that's another potential leg up for demand. And so I just kind of keep monitoring the space and look for setbacks or advancements in the network effect of Bitcoin and some of the other protocols.
God, super fascinating. So want to earmark that for when we have you on again, Lyn, to really dive into, what are the applications of the technologies and the business models that you find most exciting going forward.
Happy to.
But we don't have time now. We got to wrap things up. As we do, for folks that are interested in learning more about you and your work, where should they go?
So I'm at lynalden.com. I have a lot of free material. I have a public newsletter that you can sign up to. I also have a low-cost research service, and I'm active on Twitter at Lyn Alden Contact.
Awesome. And we'll put those URLs up on the screen when we edit this. Lyn, thank you so much for joining us for this conference. Phenomenal discussion. Thank you.
Yep. Thanks for having me.
All right. Well, if you enjoyed that conversation with Lyn Alden, and I think most of us did, she's incredibly sharp. She has a lot more to say about her thoughts on the future of the global reserve currency system in a white paper that she's made available to us for you to download. That is called The Fraying of the U.S. Global Currency Reserve System, in which she gives both her intermediate outlook on the future of the dollar versus other major global currencies, but also her long-term outlook, which she sees as a slow restructuring towards a multi-reserve asset system. And if you're interested in reading that presentation, really more of a nice long white paper on her part, you can get that at wealthion.com/currency. All right, and as I do every week, I'm now going to talk with the lead partners at New Harbor Financial, the endorsed financial advisor by Wealthion. This week, we're going to be talking with lead partner Mike Preston. Hey, Mike, how are you?
Hello, Adam. How you doing?
I'm doing great, and I understand that John is off on a well-deserved vacation. And folks, you'll see here that I'm actually on vacation as well. You can tell by my different background here. We're recording this right before the July 4th weekend. So I think John's already well off enjoying that with his family. He deserves to do that. You were taking vacation a few weeks back. Mike and John covered for you. So now you get to cover for John. Well, let's just jump right in here. Really love to hear your thoughts on what Lyn had to say. And I was struck by how much of sort of her outlook seemed to really be complementary to the outlook and the portfolio positioning that you guys have at New Harbor, but don't let me put words in your mouth, Mike. Why don't you let us know what you think?
Yeah, I really enjoyed Lyn's presentation. She talked about a lot of common themes that we talk about. A couple things that stand out that I guess are worth mentioning that I'll recap with here. Lyn talked a lot about a very overvalued stock market. There's a number of different ways you could look at valuations. Not all of them are equal. Sometimes valuation metrics are used to distort the truth, maybe. I mean, if you look at, for instance, like trailing 12-month or forward 12-month price earnings ratios, they are notoriously deceiving. Even those ratios look extremely overvalued, but we think that they really understate just how overvalued this market is. We like to use different metrics such as the Buffett indicator, which is the total value of the stock market divided by the total economy, GDP. Lyn talked about that as being the #1 most overvalued time in history, which is true. Other things like the Shiller price earnings ratio or the margin adjusted price earnings ratio, the Shiller margin adjusted ratio, are at either the first or second most overvalued of all time. So we've been saying this for a long time. This is the first time that I know of in history that we've been this persistently overvalued for this long without consequence. So it has everybody feeling like this time is different, almost bulletproof, like the Titanic. You know, this market is unsinkable. We talk to people all day long, every day, every week, and there's a lot of feeling out there. #1 there's this uncomfortable feeling that things aren't quite right. A lot of folks that we talk to are already out of the stock market, which is great. Others aren't, and they look to us for courage to get out, which we do for them. But make no bones about it, this is the most overvalued stock market in history. Lyn also talked about being bullish on commodities. Although she said the stock market was overvalued, except for a couple pockets like international and oil, which we agree with. She likes commodities long term, and gold and silver in particular, which we're fully on board with. The first thing we want to do for people when they come on board with us is make sure they have gold and silver. And that's not normally in our managed account. We just want to make sure they have it, preferably delivered to them or somewhere they can get their hands on. So gold and silver and other commodities we think are in a long-term secular bull market. She also talked about lower dollar post-COVID, and that certainly has played out over the last year because of loose fiscal and monetary policy, but we think we're entering a period of stronger dollar. Believe it or not, it's completely counterintuitive with all of the reckless money printing we've had, but the dollar actually looks to strengthen here in the next year or two from a technical perspective. Long term, we think it's inevitable the dollar really has pressure and maybe even collapses. But here in the next year or so, probably some strength and even some deflationary forces. So that's what we see. There's more to that talk. I want to take a breath and stop talking myself for a minute and allow you a moment, Adam. But those are some recaps that I enjoyed.
All right, great. Yeah, Lyn did say something about gold that I hadn't heard many people say before. And I actually think it is interesting to maybe just spend a minute talking about here, which is gold as a bond substitute in a extremely low to zero interest rate world, right? So when bonds aren't yielding much return at all, like they are right now, much yield at all, like they are right now, precious metals look better on a relative basis, right? One of the criticisms of them is that they don't produce a yield. Yeah, well, bonds aren't really producing a yield right now, right? But there's a lot more safety that comes along with precious metals because there's no counterparty risk the way that there is with bonds. And Lyn mentioned that both technically and fundamentally, she agrees that the precious metals are very well positioned right now. And as she looks out with her macro lens, she sees that these negative interest rates, negative real interest rates that we have right now is persisting for a prolonged period of time going forward, which is gold positive and bond negative. And so in comparing the two sizes of those markets, she said, look, there's only several trillion of precious metals out there, and most of those are held in the bank vaults of the world central banks. So when you look at the actual number, the amount of precious metals that investors can invest in, you're really only talking about a low single-digit $1 trillion number. And that compares to the hundreds and hundreds of trillions that are in both the bonds and the stock market. And so her point is if you even have just a couple percentage points of capital moving from bonds and potentially equities over into the precious metals, you're just going to see, bananas types of returns in the precious metals, because you're swamping what is a relatively very small market. So I thought that was really interesting. Curious to hear your thoughts on that, Mike.
Yeah, I think that, it's tiny. It's tiny. I think I read somewhere that you could put all the world's gold, into like an Olympic-sized swimming pool, which just is mind-blowing to me. It's a tiny market overall. Silver market's even tinier. So yeah, the way that we look at gold and silver, and everyone's got different reasons for it. We look at it as a hedge against runaway inflation. We look at it as a way to get out of the system, get out of the central banking kind of warped, deranged system. And you don't have to put all of your money in gold, although we've talked to plenty of people that have, and they seem to sleep well at night. And frankly, I can't blame them. But what we are advocating is maybe, anywhere between 10 to 20% of one's investable assets in gold and silver. And, the way that I look at it anyway, is that gold and silver should do well over the next few years, just from the kind of the technical tailwind that they have. But they could do a lot better if we get a scenario that we think could happen, which is runaway money printing and hyperinflation. Just to be clear, I think that maybe 0 to 2 years from now, we have deflationary forces and maybe lower prices and everything, maybe even gold short term. But long term, inflation, I think, sets in, and gold could easily go to $5,000 or $10,000 an ounce or more. So if you've got 10% of your investable assets in gold, gold could easily go up tenfold. Everything else you have could go to zero. I'm not saying that will happen, but it could. And, you'll still be fine. You'll be back to your original purchasing power. So that's the first thing we want people to do, is get a good position in gold and silver, gold and or silver. And then we talk about what to do with the rest. Great. And, you're talking there about sort of your advice when you talk to a new client. And for folks watching here who don't already know, the folks here at New Harbor Financial System offer a free consultation to anybody who wants to talk with them, bounce ideas off of them. There's no commitment to working with them. They just want to help people who are trying to think through how to navigate, this rocky, uncertain road ahead. They want to make sure that people are making the most informed decisions possible. But I reiterate this because we've had a lot of guests on recently that echoed this, but Grant Williams and Stephanie Pomboy, in the video we did with them a little over a week ago, they really, I think, very well articulated this, which, they see us moving back to an environment where active management is really going to become essential for capital preservation, let alone capital growth. That the upcoming volatility, the building risks in the system, that if they actually start expressing themselves, they agree with you, Mike, that we're highly likely to have some sort of deflationary impulse in the markets that brings prices down pretty substantially, and maybe even pretty suddenly. And of course, we have other guests like, certainly David Hunter and whatnot, who are predicting something even more violent than that. But we're as Lyn said earlier, she said that she sees a rotation out of growth stocks back into value, and also agrees that kind of the easy ride that investors have had over the past 10 to 15 years of just being able to put your money in the indices and watch them just predictably grow year after year, that era is ending, and it's going to be a lot more turbulent. And so therefore, you're going to have to work a lot harder to find a real hidden value out there, that the indices are not going to be kind of the guaranteed returners that they've been. And that to do that for most people, it requires a focus, a time demand, and really an expertise that they don't necessarily have right now. Most regular people are just trying to get through life, trying to get to their jobs, support their families. They don't really have the time to do this. And so, working with an active manager who, understands both the risks and the opportunities that our guests like Lyn are talking about is going to not only kind of come back into vogue, but I think it's going to have to become the way in which most people manage their wealth going forward, because the rules that have worked for the past 10, 15 years are breaking down and likely not going to work going forward. All right, Mike,
I'll let you have the last word here, but as you guys look at the current markets, as I look at what's happened since last week, it's kind of a whole lot of not much, except just sort of a continuation of a slow motion melt up here, it looks like. But I see that we're at about 4,300 on the S&P. Pretty much every index is at all-time highs right now. What do you have to say about the current market action?
It's concerning, Adam. It's very concerning. It's obviously concerning for guys like me that are warning people all day long, every day, about how extreme and how dangerous this market is, and yet it doesn't have a care in the world. We just hit another new all-time high this morning, 4,300 or so. And it's happening on low volume with the least amount of participation really in history. The last 5 days, I think, 3 or 4 of them out of the last 5 have had the lowest number of stocks hitting all-time highs while the broad indexes are hitting all-time highs. The breadth is pretty amazingly low. And, the skew, which is a measure of kind of options and risk in the market, is extremely high. And yet it doesn't matter. Nothing matters to this market. It just doesn't matter. And then, we've seen euphoria and fear of missing out going, on 6, 7, 8 months in a row now. Small call option buyers have blown out all of the records. Margin debt's at all-time high, valuations are at all-time high, and yet there's not a single care in the world. And even diehard conservative people like myself that have been, that see the real data and have been concerned are getting fatigued, very fatigued by this. And we do our best to continue to just tell the same story because nothing has changed, except this is the biggest bubble we'll ever see. I'm convinced of it. So one of these weeks will come on and there'll be something different. But for now, everything's just gotten a little bit more extreme than last time we talked.
All right. Well, thanks for that recap, Mike. And I want to thank you on behalf of all the viewers, because I get a lot of emails and private notes from folks being so grateful for bringing you and John on to deliver the reminder of the context of what's going on here. Because to your point, as you said, sort of nothing seems to matter at this moment, right? Which makes people really question their judgment. Oh, am I wrong? Are the rules different than my logic is telling me they should be? And your reminders are very helpful in grounding us and saying there's nothing wrong with our logic. There's really something wrong in the market's logic right now. And we all know that saying that the market can remain irrational longer than you can remain solvent. And I think there's a lot of people that are probably struggling with that right now. But I think the reality is that nothing matters until it suddenly will, right? That's sort of the reality of this market. And we just want to make sure that people are keeping the big picture in mind, so that they're positioned in an intelligent way that when, not if, but when reality reasserts itself, that they will not be at risk of being undue collateral damage then. And as we wrap up here, just a couple quick reminders. If you want to figure out how to set up one of those free consultations with Mike and John and the team at New Harbor, just stick around to the end of this video. We tell you how to do that. That's coming up in just a second. Make sure, if you haven't done so yet, please subscribe to this video. That helps us get to this video channel. That helps us get great guests like Lyn Alden on. If you want to find out who's coming on in the future or suggest guests of your own, you can follow me on Twitter at MenloBear. And one last reminder, if you want to get Lyn's white paper that I talked about, the one called "The Fraying of the U.S. Global," the Fraying of the U.S. Global Currency Reserve System, you can download that at Wealthion.com/currency, and that's totally free. All right, Mike, have a great week, and thanks for watching, everybody.
Thanks, Adam. Have a great week. See you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, And when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market will always take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.